Good evening, everybody. Yeah. Good evening, everybody. Uh, this is our second session about the topic assessment of companies. CA final direct tax laws, assessment of companies, the second session. First session, we had a detailed discussion about some very basic fundamental concepts related with the assessment of companies, including what are the rates of taxes depending upon the turnover of the companies, what will be the different rates of taxes, how surcharge is to be calculated. A very, very important discussion we had in our last session regarding this marginal relief when surcharge is to be calculated. Then that optional rate of tax regime, section 115 BAA and section 115 BAB, these two sections we analyzed in the last session. We also talked about share the buyback tax. We also talked about treatment at the time of liquidation of companies. So various aspects related with the assessment of a corporate entity, assessment of a company is what we had a discussion in the last session. Okay. Now, this session, we shall be focusing exclusively on a very, very important topic, not only related with the assessment of companies, but in fact, for whole of the direct tax law subject at CA final level, a very, very important topic that is this minimum alternative tax MAT. Okay. As I have mentioned in last session also, CA final direct tax law is highly focused on the corporate assessees. A normal understanding is this, that at inter IPCC level, all issues related with the individual assessments have been covered. Corporate assessment cases, corporate assessment matters, they are of special importance at the final level. Okay. So in that perspective, in that respect, companies assessment, now this MAT becomes a very, very important topic, a very important concept, a very different kind of calculation is involved with respect to a very different kind of concept is there with respect to this minimum alternative tax MAT. So our today's session shall be focusing exclusively on understanding this whole concept of MAT in quite detail. Okay. I can understand those who are seeing this telecast live. This is, say, New Year Eve. Probably outside, lot many of your friends might be celebrating, might be planning to celebrate New Year. As a chartered accountant student, probably Diwali and New Year and all the festivals may become a little bit, say, irrelevant kind of thing, that the prime focus is always on the studies. So really interesting to see lot many students logged in despite of this being, say, New Year Eve. So we start our discussion right away. Okay. Tax on book profits of the company, minimum alternative tax MAT. And as I have mentioned in my earlier sessions also, the prime focus of my session is to give you those concepts which are normally not clear at other places. There are some part of the discussion which you can get from anywhere else, which is written in the books, which is covered by institute study module. You can get it from other places also. But then there are number of issues, the final analysis, which is not easily available at other places. And these final analysis is going to be our main focus of discussion even for today also. Okay. Fine. Before this, there is a query. Notes regarding previous classes. Okay, won't it be uploaded? Devi from Kerala. Okay, Devi, I'm not very clear what is the process at the institute level. I will try to talk to them and find out what is the process about uploading the notes. Okay. In any case, let's concentrate on today's discussion. Tax on book profits of the company, minimum alternative tax. As I was saying, focusing mainly on the final concepts and then using a PPT which is designed to create a focus on the important concepts. Okay, avoiding all the clutter avoiding all the unnecessary things, we shall be focusing through this PPT on some main concepts. Okay. So number of slides, you may wish to take a snap, at least you can take a screenshot in order to have a reference in future also. Or obviously you can see this telecast later on again at YouTube also. Okay. So minimum alternative tax on book profits of the companies. Basic concept. Before we go into the detailed calculations related with the math, let's try to generate that conceptual connect in the mind. Okay. In examination, when this whole math issue will become relevant. Okay. In a real life situation, when math should come in the mind of a tax professional, what is the basic concept of math? Very simply, MAT, as the name itself gives me an idea, minimum alternative tax. It is minimum tax and it is alternative tax. MAT is the minimum amount of tax which a company is required to pay. Okay, this is the first concept. You should get it very, very clearly. The minimum tax which company is required to pay is this MAT. Okay, they may pay higher than what is this MAT, but they cannot pay lower than this. Okay, minimum amount of tax which a company is required to pay, minimum alternative tax. Now this tax is calculated on the basis of book profits of the company. Okay. Now the idea is this: my normal tax, what we had a detailed discussion in the last session, the normal tax of any assessee, including for any company, the normal tax is calculated on the basis of taxable income. There is a complete process of calculating the taxable income given in various sections of the income tax. So following that process, I calculate taxable income of an assessee. Then on that taxable income, I apply the rate of tax, and this gives me the tax liability of an assessee. For all the assessees, how much is the tax payable? The matter ends there. Once the taxable income has been calculated and the rate of tax has been applied on that taxable income, it gives me my tax amount. For the normal assessee, matter ends there. In the case of a company, this is not the completion of the process. Once I have calculated the normal tax liability of the company as per the normal taxable income, then I need to find out whether this normal tax liability is less than the tax calculated as per MAT. If this is so, then MAT would be the tax payable, because MAT is the minimum amount of tax payable. So a normal tax liability is calculated on the basis of taxable income. MAT is calculated on the basis of book profits of the company. So the base of MAT calculation, the basis of MAT calculation is the book profits of the company. This book profit is going to be a very, very important concept for the purpose of whole of this MAT understanding, whole of our discussion. We shall be again and again and again using this particular term, book profit. Okay. So right now the idea is this: normal tax is calculated on the basis of taxable income. MAT is calculated on the basis of book profits of the company, and this tax, which is calculated on the basis of book profits of the company, is the minimum amount of tax which a company is required to pay. Okay. Now, calculation methodology. MAT will involve a very detailed kind of calculation, and in this whole session, we will be doing number of questions also. Okay. Some live questions we will be doing. But before this, the calculation methodology at a glance. Okay, the overview, the bird's eye view of the calculation methodology involved for the purpose of MAT. What I need to do in examination with respect to MAT, what I need to do, what a company is required to do with respect to MAT. So MAT says that if the tax payable by a company, that is tax payable as per the normal provision, is less than 15% of its book profit, then the book profit shall be deemed to be the total income of the company. The tax payable by a company is less than 15% of its book profit, The book profit shall be deemed to be the income of the company. Book profit shall be deemed to be the total income of the company, and 15% of book profit shall then be tax payable by the company. Okay. So the side infograph should give you a complete idea what is MAT impact liability as per the normal provisions of the Act, or 15% of the book profit, whichever is higher, that is going to be the tax liability of a company. Okay. So at this moment, what concept I can create in mind? Okay, my answer always depends upon what is my conceptual understanding. What is the concept sitting in my mind that invariably results in the answer of whatever I write in my copy. So the concept which I need to create in my mind is what is the tax liability of a company? If anybody asks a question to you, what is the tax liability of the company? Now, normal person would reply, whatever is the taxable income, 25 or 30% of that income would be the tax liability of the company. Okay. An informed person will give in reply, no, the tax liability of the company is not 25 or 30% of its taxable income. The tax liability of a company is 25 or 30% of its taxable income, or 15% of the book profit, whichever is higher. This is what should be the concept in the mind of each one of you. Now onwards, if anybody asks a question to you, what is the tax liability of the company? Don't give simply the answer that 25 or 30% of the taxable income. That is only half of the answer. The complete answer would be the tax liability of the company is 25 or 30% of total income, or 15% of book profit, whichever is higher. Keep the concept in your mind in this manner. That will help you to respond properly. Then your response will become automatic. Then you will not be required to pressurize your mind. In the case of a company, oh, MAT is applicable or what? Keep everything in a very simple, clear-cut manner in mind. What is the tax liability of the company? Those who are having only half knowledge of the income tax, they will say the tax liability of the company is 25 or 30% of its income. We should be answering tax liability of the company is 25 or 30% of its income, or 15% of its book profit, whichever is high. Okay. The basic idea, the basic conceptual setting in the mind. Remaining calculations we shall be discussing subsequently. What is this book profit, 15%, and how to do all these calculations. But the first basic elementary level of understanding should be like this. 25 or 30% of taxable income, or 15% of book profit, whichever is higher. That is what is the final tax liability of the company. Okay. Fine. Concept of MAT, basic calculation methodology. And now let's try to create a visualization about the process of MAT. What is this complete process of MAT? What a company is required to do to calculate its tax liability considering the provisions of the MAT. What should be the complete process? So company has to first calculate its taxable income as per all the normal provisions, whatever is my taxable income. Then on that taxable income, company has to calculate its tax liability. What we can call is the normal tax liability, depending upon the turnover in the financial year 18-19, 25% or 30% rate. This all we had a discussion in the earlier session. So tax liability as per normal provision is to be calculated. Taxable income, on the basis of taxable income, the tax liability is to be calculated as per normal provision. This is half of the job. Then another process which company has to follow is to find out book profit as per statement of profit and loss. Now this book profit is required to be adjusted. For the purpose of this whole MAT calculation, number of adjustments are required to be done to this book profit. And in fact, whole of the story of MAT is actually the story of this adjustments to the book profit. We are going to spend a good amount of time in actually understanding what these adjustments are. But right now, at a very elementary conceptual level, what the company is required to do, calculate, find out, take up the book profit as per its statement of P&L. Now, do certain adjustments to this book profit. The company would be able to find out its adjusted book profit. Then company has to calculate 15% of its adjusted book profit. On one side, tax liability as per normal provision. On other side, 15% of adjusted book profit. Compare whichever is higher. This is what is the tax payable by the company. This process should get etched in the mind of everybody. Okay, if each one of you who are say seeing this session, or who are part of the session, this process should be there in your mind. What is the process of MAT, and in fact, what is the complete process of calculation of tax liability of a company? As I was saying earlier, also maximum person will give you a reply with respect to only this process. How much is the tax payable, taxable income, and then the rate of tax? No, this is only half of the job. The complete process of tax calculation of a company is these two things. Compare whichever is higher. That is going to be my MAT liability. That is going to be my tax liability in respect of a company. Okay. So this is what is the basic calculation, basic process. Number of questions I'm getting with respect to this book profit, 15% of what, and all these things we will be discussing in detail subsequently. Okay. Fine. So now, after having this idea about this basic process, basic concept related with the MAT, now the main calculation part. Okay, the main provision related with this MAT. Okay, section 115 JB is the section what we are discussing with respect to MAT. All the provisions are under section 115 JB. Okay, so book profit for MAT, as I have mentioned already, that the whole story of MAT is actually the story of adjustments to book profit. What adjustments are to be done? How to find out the book profit? The 15% of which is going to be my MAT liability. Okay, so what is that figure? What is that magic figure? What are the adjustments which are required to be done to the book profit? The complete process, the complete step-by-step calculation related with the book of profit. Okay, book profit format. So it starts by saying that what is going to be my book profit format? The very first thing, for the purpose of this section, every company is required to prepare a statement of P&L account for the relevant previous year. In accordance with the provisions of Companies Act 2013, or if the company is governed by any special act, then in accordance with that particular act. Okay. So the very first thing for the purpose of MAT, the company is required to do is to prepare a statement of P&L account as in accordance with this Companies Act provision normally. In fact, we all can understand that company in any case is preparing the statement of P&L account not for the purpose of MAT, but for the purpose of its own shareholders. Company is already preparing the statement of P&L account. These accounts are to be produced before the AGM. These accounts are required to be filed with the registrar of companies. So Income Tax Act, when it says that company has to prepare a statement of P&L account, actually, it means that whatever is the profit and loss account prepared by the company as per this Companies Act Schedule 3, that P&L account is going to be my starting point for the purpose of MAT calculation also. Okay. Now, it clarifies this thing further that this statement of P&L account based on which the book profit for MAT is to be calculated, the company has to follow those accounting policies and standards and those methods and rates of depreciation which have been followed for the purpose of statement of P&L led before the company at its AGM. Okay. So Act actually trying to say that company has to prepare a P&L account similar to the P&L account which has been presented by the company before its AGM. Practically, it means that whatever is my balance sheet as per company's account, whatever accounts have been audited for the purpose of Companies Act, whatever are the final accounts led before the annual general meeting of the company, those final accounts, that statement of profit and loss is going to be my starting point for the purpose of MAT calculation. Okay. That P&L account is going to be my starting point for the purpose of this whole MAT calculation. Okay. One small clarification related with given by the Act further. One small clarification, not of much of say importance as such, but still there is the clarification given by that. This is possible that the financial year which company is following may be different from the previous year. In income tax, previous year is standard 1st of April till 31st of March. The financial year which company is following for the purpose of its annual general meeting may be different from the previous year as per Income Tax Act. In that case, Income Tax Act says that that P&L account is to be used, which has been laid within the AGM, which has been done during my previous year. That financial year or part thereof is relevant, which falls within the relevant previous year. In my previous year, whatever AGM has taken place, the P&L statement used for that particular AGM, that is going to be my starting point. Okay. In any case, not much of the significance, not much of the relevance of this particular part of the discussion in a very practical manner from an examination perspective also, and in a real life situation also. Whatever is that balance sheet prepared by the company, whatever are the audited accounts of the company under the Companies Act, the statement of P&L account of those final accounts is going to be my starting point for the purpose of MAT. Okay. The profit as per that statement of P&L is going to be my starting point. Now, for the purpose of taxation, now that profit as per my P&L account is required to be adjusted by number of adjustments. Okay. Various adjustments have been proposed under section 115JB, adjustment to the book profits or MAT. So where I need to focus, where as a student of taxation, my focus should be is all about these adjustments which are required to be made. And the slide which we have just discussed in examination, they will normally give you that profit itself, okay, which is going to be your starting point. So that profit as per my audited account, that is my starting point. Now in that particular profit, what adjustments are required to be done? Okay. As I have said earlier already, this whole story of MAT is actually the story of these adjustments to the book profit. If we are able to do in the examination, if we are able to do these adjustments properly, then adjusted book profit we will be able to calculate. Then calculating 15% of that book profit is something simple. Comparing this 15% with my normal tax liability, all these are something simple calculations. Okay. So where should be your focus? Amongst all these clutter related with 115JB, my focus should be actually on this understanding what adjustments are required to be done. So, in fact, our whole of the discussion now onwards shall be focusing only on discussing those adjustments. The idea would be to develop an expertise to understand all these adjustments in a simplified manner and to develop an expertise over all these adjustments which are required to be done to the book profit for the purpose of MAT calculation. Okay. The idea is this section 115 JB gives me a long list of number of items. Okay. Various items are required to be added. Various items are required to be reduced from the profits as given by the statement of profit and loss. The profit given by my P&L account is required to be increased by number of items, and it is required to be reduced by number of items. After this whole plus minus, whatever profit I will be having, that will be the profit, 15% of which is going to be my MAT liability. Number of items are required to be added, number of items are required to be reduced. Okay. Now, understanding these items which are to be added and which are to be reduced, and more importantly, memorizing these items is a challenge, is a difficult task. Make no mistake. Okay. Understanding them, memorizing them, and then should be able to apply them in examination. These are three different stages of our understanding. I always say this thing, at least for the taxation paper, we should be clear about these three different stages of my learning. My learning should be something which helps me in all these three stages. Simply understanding is not sufficient. After understanding, I need to memorize, keep it in memory at least till the examination, and then in examination I should be able to apply whatever I have memorized. I should be able to apply in a proper manner. This is also something very, very important. So all these book profit adjustments have a difficulty at all these three levels. So make no mistake, understanding them, memorizing them, and then be able to apply them, going to be a difficult task. Okay, so let's try to focus. Let's try to see all these adjustments with absolute alertness of the mind, with as much focus as possible. Okay, what I have done, I have tried to simplify it. You will find the way it has been discussed in the books and in the study module, and the way it is being discussed in this PowerPoint presentation a bit different. I've tried to create some logical analysis in order to discuss what all these adjustments to book profits are to be done. Okay, we will be able to appreciate them as we will go through them. But the first basic idea is this: for MAT calculation, various items are required to be added, various items are required to be reduced from the profit as given by the statement of profit and loss. Okay. The basic process, the basic concept of all these adjustments. Okay. When we will be discussing, when the act discuss this, when the books discuss this whole adjustment, now they basically give all the items of four different categories. There are certain income which are credited to P&L account, but then 115 JB says that these are not taxable for VAT. And then there are certain income which are credited, but they are not taxable for VAT. Then I need to reduce these items for my MAT calculation. From my book profit, I need to reduce all such income which are credited to P&L, but they are not taxable for MAT. Okay. Then there are certain expenditure which are debited to P&L account, but they are not deductible for MAT. I need to add these amounts. What I would be doing, I would be scanning my P&L account, credit side, try to find out are certain income credited there which are not taxable for MAT. If yes, then I will be reducing my book profit by all these amounts. I will be scanning debit side of my P&L account, try to find out whether any expenses are debited to this P&L account which are not deductible for MAT. These expenses are not deductible for MAT, but they are debited in my P&L account. So my profit has been already reduced by these expenses, but they are not deductible for MAT. So for my book profit calculation, I will be adding back items of this nature. Then there may be certain income which are not credited to P&L, but they are taxable for MAT. There would be certain items, when we will be discussing it further, we will find certain items which are credited to P&L, which are not credited to P&L, but they are taxable for MAT. So there are certain items which are not part of my P&L, which there are certain income which are not part of my P&L. They have not been credited, but provision says that they are liable to be considered for MAT purposes. So what I will be doing? I will be increasing my book profit with these items. Those items which are taxable format, but they are not credited to P&L. If they are already credited to P&L, we all are students of accountancy. We all can understand the impact of something debit to P&L and something credit to P&L. Something which is credited to P&L, that means my profit is already increased by that much amount. Something which is already debited to P&L, that means my profit has already been decreased by this much amount. Now there are certain items which are taxable format and they are already credited to P&L. Nothing is to be done. But there are certain items which are taxable format, but they are not credited to P&L account. They should have been credited, but they are not credited. Then what I need to do for MAT purposes, I need to increase my book profit by this much items. And similarly, there are certain expenditure which are deductible for MAT purposes, but they are not debited to P&L account. If they are already debited to P&L account, that means my profit already stand decreased. But then these are deductible format, but not debited to P&L. What I will do for the purpose of my MAT calculation, I will reduce my book profit by this much amount. Okay, so whole of this discussion related with the book profit adjustment is basically trying to understand what is to be added to the book profit, what is to be reduced to the book profit. Okay, no percentage calculation, nothing else is required to be done. The only calculation is to be done is something to be added, something to be reduced. Now, what is to be added, what is to be reduced? This is what is the conceptual idea about it. Okay. Any income which is not a taxable format, but it is credited to my P&L account, I will reduce my book profit by this much income. Any income which is taxable format, but it is not credited to my P&L account, I will increase my book profit by that much income. Any expenditure which is debited to my P&L account already, but it is not deductible for my MAT, I will increase my book profit by this much amount. Any expenses not debited to P&L, but it is deductible for MAT, my book profit will be reduced by this amount. Okay, just apply your accounting logic to this particular slide, to this particular 4 squares, and then you will be able to appreciate what exactly we are trying to say. If I get this idea clearly in mind, whatever is the remaining discussion becomes little bit easier for me to understand. Okay. Now, sorry. What are the adjustments? What is to be added? What is to be reduced? What is the logic of this reduction and addition? We have tried to generate some idea here. Now come to the actual items which are required to be added and which are required to be reduced. Okay. And then what I have done for the purpose of this discussion, I have said the act gives me simply a list of different items which are to be added first. Then later on, it gives me a list of all those items which are to be reduced. Okay, this is how the act has been structured. Normally, the books do a simple copy paste. Whatever is written in the act, they simply adopt it. So almost everywhere you will find this kind of discussion. These 5, 6, 7, 8, 10 items to be added, 5, 6, 7, 8, 10 items to be reduced. What we are trying to do here is to develop a logical understanding. Okay, there are various items which are interconnected with each other. So rather than discussing them separately, we will try to discuss them as a bunch, as a category, Probably that will help us to commit to the memory in a more easier kind of manner. Okay, there are categories of the items which are to be added, which are to be reduced. So we are categorizing them, we are bunching them together in order to develop a better understanding. Okay, so what are these book profit adjustments? For the purpose of math calculation, for the purpose of this math calculation, the basic process is this. My company has already calculated its normal taxable income and the normal tax liability as per the taxable income. Now my company is in the process of calculation of MAT. For the purpose of MAT calculation, whatever is the profit given by my statement of P&L audited account, that profit has been taken as a base. In that base figure, now various adjustments are required to be done. We are trying to understand these adjustments. We are standing at this particular point of the question where you have already taken the profit as per audited account, and then you are finding out how this profit is required to be adjusted, what is to be added, what is to be reduced. So first category of this addition deduction, I will not say first item. Now we are discussing them in a categorized manner. So first category of this addition deduction are three pairs of income and related expenditure. Okay, three types of income. If they are credited to my P&L account, they are to be reduced from the book profits, and then expenditure related with these income, if they are debited to my P&L account, they are to be added to my book profits. Okay, so three types of income are to be reduced, and expenditure related with these income are to be added. If income credited, they are to be reduced. If expenditure debited, they are to be added back. Okay, so three pairs. First type of income, any income exempt under section 10, 11 or 12. Okay, a very, very important adjustment. Any income exempt under section 10, 11 or 12. Okay. Now in one single word, Act has opened up a whole Pandora's box for us. When they are saying any income exempt under section 10, they are talking about number of income. Now we can recall section 10, a whole list of income, and all these income, if they are credited to my P&L account, they are required to be reduced. Say for example, the prominent example we can generate with respect to section 10 income, A is agriculture income, B is profits, share of profit from the partnership firm. Okay, any share of profit from a partnership firm, that is also exempt. Till last year, dividend also used to be exempt under section 10. Now it is taxable. From this year onwards, the dividend is not exempt. So two important income which are eligible, which are exempt under section 10 are agriculture income, share of profit from a partnership firm. So in examination, how to apply the provision? Okay, understanding the provision, memorizing the provision, and then applying the provision. So how to apply the provision? In exam, they will not give you similar terminology which you have memorized. You have memorized income exempt under section 10. In exam question, they will write about share of profit from a partnership firm. I should be able to connect in examination that share of profit from a partnership firm, that means income exempt under section 10. That means for MAT calculation, this income is to be reduced from the book profit. Okay, so clarity of thought should be there. The first item which is to be reduced, the first item, I'm deliberately not answering your questions right now. Number of questions are coming. You keep on throwing all these questions. Most of these questions will get answered during the course of our discussion itself. If at all any question remains unanswered, then we can discuss it at the end of the class. Okay. So the first income which is to be reduced, first item to be reduced, that is income exempt under section 10, 11 or 12. Okay. Second income which is to be reduced, that is if this company is a member of any association of person or body of individual. If the company is a member of any AOP or BOI, the share of assessee's income from that AOP or BOI as per the provisions of section 86. Okay, that AOP BOI assessment also I will be discussing with you in one of the next session. But right now, with respect to company, the idea is this: company is a member in any AOP BOI. Whatever share company has received from that AOP BOI, as per section 86, no tax would be payable on that particular share. So for MAT purposes, this share of this company's share in the income of AOP BOI, this a share will also be reduced for the purpose of calculating book profit for MAT purposes. Second income to be reduced. Third item which is to be reduced, third income which is to be reduced, that is income by way of royalty, on which tax is payable under section 115 BBF. Section 115 BBF is a special section. It talks about certain types of royalty income taxable at a special rate. For MAT purposes, only that much we need to keep in mind, that any royalty taxable under section 115 BBF, if this much royalty is credited in my P&L account, then that royalty income is also required to be reduced for MAT purposes. Simultaneously, we can generate a conceptual clarity in back of the mind. Whatever items Act is saying they are to be reduced for MAT purposes, that means on these items, ultimately MAT is not applicable. If these income are credited to my P&L account, part of my profit, now for MAT purposes, they are saying that I can reduce this much amount from my profit. That means my profit for MAT will go down. That means these much items are not taxable for MAT purposes. So any royalty income taxable under section 115 BBF, it is taxable for my normal tax calculation as per the rate given in 115 BBF. But this income is not taxable for MAT purposes. That's why law is saying that from your book profit, you can reduce this income. Okay. So three types of income which are required to be reduced. The first case we are seeing income exempt under section 10, share of profit from an AOP BOI, and then royalty income under section 115 BBF. All these three income are to be reduced. And then to complement this concept, one simple idea: any expenditure related with these income, if these are debited to my P&L account, these expenditures are required to be added back. We can get this concept clearly using our accounting concept. Income is credited in P&L account. That means my profit is already increased by this much income. Expenditure are debited to P&L account. That means my profit has been reduced by this much amount. Now, whatever income is credited, you are saying from profit, that income is to be reduced. So very logically related with that income, whatever expenses are debited in my P&L account, these expenses amount are to be added back to my profit. Basically, what the Act is trying to do, Act is trying to remove completely the impact of transactions of this nature. Say, for example, there is agriculture income of 10 lakhs credited in my P&L account and agriculture expenses of 6 lakhs debited in my P&L account. For MAT calculation, what they are saying, book profit shall go down by 10 lakhs, the income credited. Now, what about those expenditure which are already debited in my P&L account? Book profit will go up by the 6 lakhs. 10 lakhs less, 6 lakhs plus, net, my profit will get reduced by 4 lakhs. So this is what is the mechanism contemplated by the law. Whatever income of these three types credited to P&L account, reduce it from book profit. Expenditure related with this income debited to P&L, they are required to be added back. Okay. Again, in the books, in the Act, everywhere else, with respect to this expenditure, you will find three entries. Okay, for each expenditure related with each of the income, they will be giving you a separate mention. But rather than keeping in mind these three things, just keep in mind one single idea, that These three income are to be reduced. Expenditure related with these three income, if they are debited to P&L account, they are required to be added back. Okay. Fine. So first set of items which are to be reduced and which are to be added back. Okay, payer of income and expenditure. Income to be reduced and related expenditure are to be added. Okay. Second category of adjustment, as I have said, we will not be discussing item by item, but we will be discussing category by category adjustment in order to help you probably develop a better understanding rather than discussing item by item manner and unnecessarily creating, say, length of the provision, unnecessarily increasing the length of the discussion. We are trying to generate a more focused idea, a comprehensive picture we are trying to generate by discussing all these adjustments, bunching them in categories. So first category, we have talked about the special income and expenditure related with those income. Second category, adjustments related with the reserves and related with DTA, DTL, deferred tax asset, deferred tax liability. Okay. So something very simple. Any amount withdrawn from any reserve or provision credited to P&L account is to be reduced from the book profit. Again, if you apply your accounting logic, if you wear your accounting hat, you will be able to understand it very, very simply. There is certain amount which has been withdrawn from a reserve and credited to my P&L account. Because of this, my profit has been increased. Amount withdrawn from any reserve credited to P&L account, it has resulted in my profit getting increased. But actually, this withdrawn from reserve is not my income, though it has been credited to P&L account, but actually it is not my income. This credit is a part of my profit. If I don't reduce it from my profit, I will be unnecessarily paying a 15% tax on this credit item also. So that's why law is saying that any amount withdrawn from any reserve, any provision, credited to your P&L account for MAT calculation, book profit shall be reduced by this much credit amount. And now, if you are able to follow the concept, you should be able to get the next point without any effort. Amount withdrawn from reserve, credited to P&L, that is to be reduced. Amount transferred to any reserve by debit to your P&L account, that is required to be added back to your book profit. In your P&L account, some debit is there. Through the debit, some amount is being transferred to any reserve. Because of this debit to P&L, my profit has been reduced. But this transfer to reserve is actually not an outflow. It is not actually an expenditure. It is only an accounting entry. So for MAT purposes, Act as saying that nullify the effect of this accounting jugglery. Any amount debited to P&L account, transfer to any reserve, add back it to your profit for MAT calculations. Okay. Next set of adjustment. Amount of deferred tax assets credited to P&L account, reduced from book profit. Amount of deferred tax liability debited to P&L account, increase your book profit. Simple. Direct deferred tax liability debit, deferred tax asset credit. The impact of this debit and credit is to be nullified by reducing the credit amount by adding back the debit amount. Okay. Fine. So first slide, we have talked about three income to be reduced and expenditure related with this income are to be added back. Next slide, we have talked about credit from reserve, transfer to reserve, deferred tax asset, deferred tax liability. Say very easily, we have actually covered 10 items of that list. In the book, in the notes, you will find a long list kind of thing. Very easily, very simply, we have actually covered 10 items out of that particular list by simply categorizing them into two different categories. 3 income, expenditure related with this. So 6 items. Now 2 items to be reduced, 2 items to be added, what we are discussing here. So all in all, 10 items we have already covered. Now 5 other items are to be added. And as I have said, it's a long list. What is to be added, what is to be reduced. So now 5 other items are to be added. 5 other amounts to be added, debited to P&L account. These amounts are also required to be added back. What are these 5 items? First is amount of income tax paid payable provision therefore. Any amount of income tax paid payable provision therefore debited to P&L account that is required to be added back. Okay. My book profit, which is my starting figure, that is my profit after tax. Okay, the final figure of my P&L account, that book profit is my starting figure. That book profit is already standing reduced because of this debit to P&L on account of income tax. So tax law says that whatever is the income tax paid payable of provision therefore debited to P&L, that is required to be added back. Okay. Now here, before we move forward, I would like to draw your attention to one very peculiar situation with respect to direct tax laws. Okay. Now, what is that peculiar situation? Whenever you are studying tax laws, or for that matter, any law, always try to get the exact meaning of every term which is used there. For example, here they are talking about income tax to be added back. What exactly is the meaning of income tax? You feel, sir, I understand, but we don't understand. We don't understand completely. When the act is saying income tax is to be added back, what all things are required to be added back? Section gives me a further clarity. Let's see that clarity and then we will discuss this further. So what they are saying, amount of income tax here will include dividend distribution tax. Till last year, if companies were distributing dividends, so DDT was payable. So amount of income tax here includes dividend distribution tax. It also includes any interest charge under the income tax. Okay, so for this MAT calculation, you are required to add back not only that provision for income tax, but you are also required to add back the interest paid under the income tax act. Under any section of income tax, if any interest has been paid, that is also required to be added back. Then income tax here includes surcharge, cess also. So any amount paid or provision for the purpose of surcharge or cess, that is also required to be added back. Now see it very, very carefully. There are a number of interesting issues involved here. And as I have said earlier also, the whole purpose of our discussion is to generate focus on those items mainly, which are not normally clear otherwise. So what is included in income tax? When the act is saying income tax is to be added back, what actually is to be added back? The amount of income tax, the amount of dividend distribution tax, surcharge, cess, and any interest under the Income Tax Act is required to be added back. Okay. So for example, if there is an interest payable under the Income Tax Act for late payment of advance tax, delay of advance tax, you might have studied it already, section 234B, 234C interest, whether that interest is to be added back? Yes, it is to be added back. Whether any interest payable for late deposit of TDS, whether that is also required to be added back. Now, this is where the clarity of concept becomes very, very important. Simply reading the income tax in a normal bookish kind of manner without it trying to understand the hidden meanings may create all sorts of problems. So whether any interest for late deposit of TDS, that is also required to be added back. Now see, what is the language? Any interest charge under the Income Tax Act is to be added back. This any is a very, very powerful word sitting there. Read it with all the alertness possible. Which interest? Are they saying only advance tax interest? They are saying any interest charge under the income tax. So even a late deposit of TDS interest is there, hidden somewhere in my P&L account. Even that is also required to be added back. Now, a very interesting question I would like to raise here, and then you may send answers to chat box. Any penalty under the income tax debited to P&L account, whether for MAT purposes, it is also required to be added back. Okay, quickly, give me your answer. Any penalty under the income tax? Any answers? Penalty under the income tax. I know we all understand that for my normal taxable income calculation, penalties are disallowed. Penalties are not allowed at expenditure. We add them back for normal income calculation. Whether for MAT calculation, book profit purposes, income tax penalties are to be added back or not. Yeah, right. Yeah. And as you can see, they have very specifically defined in the name of income tax what all are to be added back. Interest, surcharge, cess. The penalty is not mentioned there. Yes, and in one of my earlier session, probably I have mentioned income tax is a very interesting subject. What is written there, that is important. What is not written there, sometimes more important. I need to see the income tax in that manner also. So the penalty is not mentioned there. What all to be added back, that is mentioned there. Penalty is not mentioned there, not to be added back. These are the areas where examiners have a say, examiners create a real twist in the question. I normally answer based on common sense. I normally answer based on conventional logic. So income tax is to be added back. So everything is part of income tax. No, they are mentioning it very specifically what all are part of the income tax here to be added back. Okay, I think another question and answer should be obvious to every one of you. Dividend distribution tax is to be added back. In the last session, we talked about the share buyback tax, whether that BBT debited to P&L account is to be added back. The obvious answer is now no. They have mentioned DDT, that is to be added back. They have not mentioned BBT, so BBT is not to be added back. Okay, so amount of income tax paid, payable, provision therefore as debited in P&L account, that is required to be added back. Be very clear, read it with the magnifying glass, underline it very clearly what all are included in income tax, and just mark somewhere that what is not included in income tax here, what is not included, that is not to be added back. Okay, then next item which is to be added back, this is a complete bunch of 5 items we are discussing. The amount of dividend paid off of course debited to P&L. This is simple. Okay, any amount related with the dividend paid off of course debited in P&L, the book profit is required to be increased by this much amount. Then next 3 items, a separate bunch again, 3 types of provisions. The amount related with the provisions debited in P&L account. Amount of provisions debited in P&L account, 3 types of provisions. Okay, any provision for meeting liabilities other than a certain liability. Okay, what we can say, any provision for any unascertain liability if debited in my P&L account. Liability is still not certain. I'm not very sure whether I will be required to pay this amount or not. But still, as a say matter of caution, I have created a provision for such unascertain liability. For MAT purposes, my book profit will be increased by this much amount. Okay. Then any provision for the losses of subsidiary companies, if debited to my P&L account, this much amount will also be added back. And then third, very important, First, we had talked about provision for liabilities, then provision for assets. Any provision for diminution in the value of any asset, if debited to my P&L account, that is also required to be added back. A very simple example would be provision for bad debts. Provision for diminution in the value of asset. Okay, so any asset value, I feel it is going down, and I have made a provision for this. Then that provision is required to be added back. So three types of provisions are to be added back: income tax paid payable provision therefore, and dividend paid or proposed. These are five further items which are required to be added back for the purpose of this book profit calculation. Okay. So this is our third category of item. In first category, we have talked about six items, three income and expenses related with them. Then next, we have talked about this reserve debit credit, DTA, DTL debit credit, four items, and then five items here. In that long list of items to be added and reduced, we have now completed 15 items. Next thing, something very, very simple, amount to be reduced. These are five items which are required to be added back. Then one item specifically which is to be reduced, if the company is a sick industrial company, during the period of sickness, whatever are the profits of the sick industrial company, it is also required to be reduced. Simple, nothing to be discussed as such. So after this 15, 16 items which are to be increased and which are to be reduced. Now there are three special cases. Okay, three very, very specific items related with the MAT adjustments, adjustment to the book profit for the purpose of MAT. Any question in examination related with the MAT, one of these three items would be definitely there in that particular question: revaluation reserve, current year depreciation, and brought forward loss, brought forward depreciation, how they are treated for MAT purposes, how they are handled for MAT purposes. Okay, revaluation reserve. Something very important. And again, you will be required to use your accounting concepts for understanding this provision clearly. What the law says: any amount standing in the revaluation reserve, any amount standing in revaluation reserve related to the revalued asset at the time of retirement or disposal of such asset, if this amount is not credited already in P&L account. Okay, we will try to understand this with the help of an example also, but first of all, let's try to get it in this manner itself. Company has revalued certain reserves, has revalued certain assets, credited that amount of revaluation to the revaluation reserve. We all can understand this thing. Now the asset which has been so revalued has now been sold off by the company. What is required? That when you are selling off that particular asset, whatever is the amount related with that asset lying credit in my revaluation account, that amount should now be transferred to P&L. Company has disposed of its revalued asset. Whatever amount related with that asset was there in the revaluation reserve, that has been credited to P&L account already, nothing is to be done. But if the asset has been transferred, amount related with it, which is there in the revaluation reserve, has not been credited in P&L account, now for MAT purposes, that amount is required to be added back. Now for MAT purposes, that amount is required to be added back. Okay. Let's try to understand this with the help of an example in order to develop that visualization. Okay. So this is what is the situation. The company had purchased two buildings for rupees 10 crores each. FY 17-18, it had revalued these buildings at rupees 100 crore each. 10 crore was my purchase price. I have revalued it for 100 crores. So 90 crore for each building, I have credited it to my revaluation reserve. Okay. Now, In the current previous year, it has sold off one of the building for 120 crore. Now in my books, that building is appearing at 100 crore. I have sold off that particular building for rupees 120 crore. Now this 20 crore profit I have credited to my P&L account. The building account was appearing at 100 crore, sale price 120. So 20 crore I have credited to P&L account. Now, what about that 90 crore with respect to that building, which is still lying in my revaluation reserve? In my revaluation reserve, there is this 90 crore related with building, which is still lying there. Logically, company should transfer that 90 crore also to the P&L account from revaluation reserve. That 90 crore credit should come to P&L. If company has done this, it's okay. But in the question, what is mentioned here, for our purposes, no amount has been transferred from the revaluation reserve to the statement of P&L. What would be the impact for MAT purposes? Law simply says that if you have not credited this, we will increase your book profit by this 90 crores amount. Okay. Very simple kind of example I have created. I hope you will be able to appreciate what exactly is the concept, what exactly is the calculation involved. So revaluation reserve. Revaluation reserve, if you have already credited this much amount, nothing is to be done. What you should have credited, but you have not credited, for MAT purposes, book profit will get increased by that amount. Okay, revaluation. First special case, three special cases are there. So first is this revaluation. Second is current year depreciation, a special treatment with respect to current year depreciation. Okay, in examination, there is this question related with the MAT. In the P&L account, obviously, invariably, amount of depreciation would have been debited. Now, for MAT purposes, what is to be done with respect to special treatment is to be given to this depreciation. What is that special treatment? Okay, Act says, first of all, whatever is the amount of depreciation debited in P&L account, it is required to be added back. If there is a revaluation, depreciation on account of revaluation also, if debited to P&L account, that total amount is required to be added back. Okay, question might give you a bifurcation. Total depreciation debited at 200, 150 is on account of normal, 50 is on account of revaluation. Whatever is the depreciation debited to P&L account, total amount is to be added back first. Then following is to be reduced. Depreciation other than revaluation, adding back total depreciation, reducing depreciation other than revaluation. Okay, other than revaluation, whatever is the remaining depreciation, that is to be reduced. Then second item which is to be reduced in this particular category is any transfer from revaluation reserve credited to P&L account to the extent of depreciation on revaluation amount. Whatever was my depreciation on revaluation amount, to the extent whatever transfer I have done from revaluation reserve to my P&L, that much amount is further required to be reduced. Okay. Again, let's try to appreciate it by generating an example. Generating certain numbers would help us to understand this problem in a more appropriate manner. Now, this is what is the excerpt from my profit and loss account. There is a depreciation debit 12 lakhs. This 12 lakhs includes depreciation on account of revaluation 5 lakhs. So total 12 lakhs is debit there. Then there is a credit transfer from revaluation reserve 6 lakhs. This is what is the information given to me. Now, what I am required to do for the purpose of MAT calculation, first is total depreciation is to be added back 12 lakhs. Second is depreciation other than revaluation is to be reduced, which is 7 lakhs. Yes. Third item which is to be considered here, second item to be reduced is transfer from revaluation reserve credit to P&L. From revaluation reserve, there is a 6 lakhs credit to P&L. But then losses against this revaluation reserve credit, only that much amount to the extent of depreciation on revaluation, that is to be reduced. So even if 6 lakhs is credited in my P&L account, for MAT calculation, I will reduce only 5 lakhs. Okay. So 12 lakhs have been added, 12 lakhs have been reduced. Right now, you can see there is no impact. Even if there is no impact, still in examination, this calculation is to be done. And then there may be an impact also in certain situation. In this case, if transfer from revaluation reserve would have been only 4 lakhs, then I would have added 12, I would have reduced 7 and 4, 11 only. So there may be an impact, there may not be an impact. But for examination purposes, in your answer, you have to give this whole calculation. Okay, total depreciation is to be added, then depreciation other than revaluation is to be reduced, and then revaluation reserve transfer to the extent of depreciation on revaluation amount that is to be reduced. Okay, transfer from revaluation reserve or depreciation on account of revaluation, whichever is lower, that is required to be reduced. Okay, current year depreciation. So revaluation reserve adjustment, current year depreciation adjustment. Third special item, that is with respect to carried forward loss or unabsorbed depreciation. The treatment for MAT purposes, book profit adjustments, loss brought forward or unabsorbed depreciation. Okay, now the basic provision is this, that any loss brought forward or unabsorbed depreciation, whichever is less, is to be reduced from the book profit. Okay, this is what is the simple provision. Okay. Behind the simple provision, there are many complications involved. But on the face of it, this is what is the provision. You will get in the act, you will get in the books. Okay, but what we need to understand is what we will be discussing. So what is the provision? Carried forward loss or carried forward depreciation is to be reduced. The very first twist created by law is whichever is lower. Now my company is carrying forward losses, my company is carrying forward depreciation. I have to reduce, first of all, I have to compare them. Carried forward loss and carried forward depreciation, I have to compare them. Whichever is lower, that lower amount is to be reduced. First twist. Second and more important twist in the provision is loss is to be taken before charging depreciation. Now, my all accounting concept says that loss is obviously after depreciation, but for MAT purposes, carried forward loss is to be seen before charging depreciation. So say, for example, there is this carried forward loss from last year is 10 lakhs. The depreciation charge in the books was 7 lakhs. Last year, 7 lakhs was the depreciation. And after charging that 7 lakh depreciation, there was this loss of 10 lakhs. The final figure of my P&L account last year was minus 10. There was the 7 depreciation and minus 10 was loss. I cannot compare 10 and 7. I have to compare loss before depreciation. So in our example, the loss before depreciation would be 3. Depreciation is 7, whichever is lower. 3 is the amount I can adjust. There is a possibility I may have a loss after depreciation, but before depreciation, I may not have any loss. The amount of depreciation last year was 7. After charging depreciation, my loss was 4. That means before depreciation, I was having a profit. And again, you need to use your accounting concepts very thoroughly for appreciating all this jugglery. So loss before depreciation. If there is a loss before depreciation, that figure or depreciation, whichever is lower, that is to be reduced. Another important thing, this comparison is to be done on a cumulative basis. I'm carrying forward losses and I'm carrying forward depreciation for last so many years. I'm not required to do this year by year comparison, whichever is lower every year. No. Total depreciation till date carried forward and total loss before depreciation till date carried forward, whichever is lower, that is to be adjusted. And then the most important point where not many people are confused, this carried forward loss, this carried forward depreciation, as per income tax or as per books of accounts? Now, sir, we are talking about income tax, so it has to be as per income tax. No. In the income tax, while talking about MAT, we are talking about accounts. We are talking about books of accounts. So this carried forward loss or carried forward depreciation, not as per income tax, it is as per books of accounts. Whichever is lower, loss before charging depreciation or carried forward depreciation, whichever is lower, as per books of accounts, that is required to be reduced. Okay, the third item. Then there is an exception. Okay, for two types of companies, whichever is lower is not the criteria. The total depreciation and total loss before depreciation, not whichever is lower, but the aggregate of these two figures, that can be adjusted for two types of companies. One company first is the company where government has appointed board of directors in suspension of the normal board of directors. Normally, whenever there is any fraud or etc. committed by company, then government has a power under Companies Act to suspend the board of directors and appoint its own nominee to the board of directors. So with respect to that company, subsidiary of that company and subsidiary of such subsidiary, this loss or depreciation, whichever is lower rule would not be applicable. Loss and depreciation, totality, they can carry forward, they can adjust. And second company for which this exception is applicable is a company which is covered by the insolvency code, against which a resolution proceeding, insolvency proceedings have started under the IBC code, Insolvency and Bankruptcy Code. If the insolvency proceeding has been started against the company, then for this company also, for MAT calculation, carried forward loss and carried forward depreciation, aggregate of this can be adjusted. For all other normal companies, carried forward loss or carried forward depreciation, whichever is lower, loss is to be taken here before charging the depreciation as per the books of accounts. So these are these three items, special items kind of thing, for which the adjustment is prescribed: revaluation reserve, current year depreciation, and then this carried forward loss, carried forward depreciation. All in all, we have talked about number of adjustments by now, by categorizing them into different categories. Various adjustments are to be done with respect to my book profit, something to be added, something to be reduced. There are certain other adjustments also, but practically speaking, whatever we have discussed till now, they are of special importance. They are of higher importance. Okay. So now what we can do, we can develop a question here and try to understand all these concepts using the numbers. Okay. Or what we can do, this is already 7:20 in my watch, time to take a break also. So I will leave this question open for you. As usual, we will have a 15 minutes break at this point of time, 7:18 in my watch. So we will resume our discussion sharp 7:33 again. Meanwhile, you can have a quick break and then you can look to this particular question also, try to solve it. After break, we will discuss this particular question. Okay. So quick 15 minutes break at this point of time. Okay, so welcome back. Various adjustments which are to be done for the purpose of MAT calculation, additions and deductions to the book profit. Okay, we had a detailed discussion of various important adjustments to be done before the break. Now, this is what is the question where we would like to apply all the concepts which we have discussed earlier. Okay, now before this, the very simple idea is this, that first of all, I need to calculate the taxable income. For taxable income calculation also, I need to do various plus minus to my profit. Based on the other provisions of income tax, I need to do this plus minus to the profit. I calculate my taxable income. For MAT purposes also, I need to do various plus minus to my profit. Now, what is plus minus to be done for normal income and what is plus minus to be done for MAT calculation? They are not necessarily same. Okay. So based on this, now let's try to calculate the total income and tax payable for this particular company. Very first thing I would like to draw your attention is this whole question is nowhere talking about MAT. Nowhere it has been mentioned that please calculate MAT liability also. So the very first problem in examination may be that while reading this question, you may not be able to recall MAT at all. And this is what I think I have mentioned earlier also. This is what is a very unique problem in an income tax. Number of times, question doesn't tell you very specifically what is required to be done. You have to supply it from your own mind based on your conceptual clarity. So the idea is this: the moment there is a tax liability calculation issue related with a company, that means a MAT has to be calculated. If examiner wants to spare you from MAT calculation, he will mention it specifically, ignore the provisions of MAT. But if nothing has been mentioned and the tax liability of the company is to be calculated, the MAT calculation has to be done. Before we start our discussion, before we go for the calculation, this first basic clarity is very important. Okay, not written in the question, but still you have to do it because it's a part of process. Whenever the tax payable of company is to be calculated, you cannot calculate it without considering MAT provisions. Okay, so MAT is an invariable part of tax calculation of every company. This is the first clarity I need to do. Okay, now this is what is the question. What I will try to do in this discussion, I also try to give you an approach how to attack a question in examination, how to go about a question in examination. Okay, my simple suggestion would be for any tax related question, don't start your calculation immediately. First, analyze that question in a proper detailed manner. Every single item of the question, what treatment is to be done, that analysis must be done before you actually start writing anything in your copy. Number of students make this mistake. The moment they see a question and they start immediately in such a great hurry, they miss out on number of things. This is taxation paper. You never know where is the bomb hidden, where is the land is slippery, and where you can simply go out of the track. So do a proper detailed analysis, a minute analysis of every single item before you actually start writing answer in your copy. And this is what we will be doing here also. First, we will be analyzing that particular question and then we'll be actually solving it. Okay. So now this is what is the question. Different items. Now what I need to do, I need to analyze every single item here. And the normal income calculation. First process would be calculating the normal income. So with normal income perspective, first of all is what is going to be my rate of tax. Now, question is not saying so, but I have done a conceptual study. So I know that because the turnover of PY 1819 was less than 400 crore, the normal rate of tax would be 25% here. Okay. This information about turnover of PY 1819 has got relevance because it tells me what is going to be my rate of taxation. Okay. So this will be 25%. Then other items for normal income calculation, this share of profit from partnership firm, I know it is exempt. So for normal income calculation, this will be reduced from my profit. Some excess I have realized on sale of land held as investment. This is actually capital gain item. So this will be considered separately. A capital gain calculation will happen. Now, depreciation on straight line method basis and provision for losses of subsidiary company for normal income calculation, they are not allowed as a deduction. So I will add them back. Depreciation as per Income Tax Act, I will be reducing it. This is my normal income calculation. This is not part of MAT. This is how I calculate my taxable income normally. Then there is this short-term capital gain on sale of land mentioned above. For taxation purposes, now this short-term capital gain of 40 lakhs, excess realized, this 30 lakhs was credited in my P&L account, but actual short-term capital gain amount calculated is this 40 lakhs. Okay, there can always be a difference. What is my gain as per accounting and what is my gain for capital gains purposes? Say for example, because of that section 50C applicability and all those, so my short-term capital gain as per taxation is 40 lakhs, credit in books is 30 only, but for capital taxation purposes it has been given to me, it is 40 lakhs. Then there are carried forward losses and then there are unabsorbed depreciation. For normal income calculation purposes, I reduce both of them. For MAT purposes, it is whichever is lower, but for taxation purposes, I reduce both of them. And then question tells me that loss brought forward as per books of accounts and as per Income Tax Act are same. Normally, they will not. Income tax loss will be different. The book loss will be a different amount. Here, question is telling me that no, you have to treat both of them same. So based on this, this is what is the analysis I have done for the purpose of my normal income calculation. Based on this analysis, let's calculate my normal income. Net profit as per P&L account, this is the first figure. Then add depreciation debited to profit and loss 100, provision for losses of subsidiary 60, 160 I have added. Then this exempt income is to be reduced. Excess realized on sale of land for taxation purposes, it will be considered separately. So I will be reducing it for my business income calculation purposes. Depreciation allowable as per Income Tax Act, that will be reduced. So all in all, my income from business, my PGBP income, my business income would be 175. So this 175, I will be adjusting my carried forward losses. I will also be adjusting my so I have adjusted my carried forward losses. 50 is the carried forward losses. 125 is my business income. Capital gains as per income tax 40. So total 165. And then the set off of unabsorbed depreciation. We must be knowing carried forward loss can be adjusted only against business income. Carried forward depreciation can be adjusted against any income. Okay. So from the total 165, unabsorbed depreciation 60 has been adjusted. My total income as per Income Tax Act is 105. This is the first calculation I have done, not as per MAT. This is as per my all earlier provisions. My total income, my taxable income is 105. Okay. Now the MAT calculation. Again, let's analyze the question with respect to MAT. Okay, same set of data. Now for MAT purposes, what adjustments are to be done? What is to be added? What is to be reduced? Now, all those items which we have discussed in today's session, items to be added and items to be reduced. So now the first item is this share of profits from partnership firm. For MAT purposes, it has to be reduced from the book profit because this is an income exempt under section 10. Okay. Then excess realized on sale of land held as investment. For normal income purposes, I have reduced this amount and I have taken total amount of capital gains. For MAT purposes, no such adjustment is required to be done. Whatever items are to be added and reduced, we have discussed, there was no such adjustment required. So for MAT purposes, this amount is to be ignored, no treatment. Then depreciation on straight line method basis, and then provision of losses of subsidiary company, they are to be added back. Okay, provision for losses of subsidiary company, there was a specific point, they are to be added back. Depreciation as per books of accounts, first it will be added and then it will be reduced also. There is no revaluation issue involved here. So total depreciation will be added and total depreciation would be reduced. Depreciation as per Income Tax Act, nothing to do for MAT purposes. Short-term capital gain as per Income Tax Act, nothing to do with for MAT purposes. Now carried forward losses and unabsorbed depreciation. Because it has been given that they are same as per books of accounts as per Income Tax Act, they are same. So now we have to reduce whichever is lower. And then we are taking an assumption that here losses are before the depreciation. The question is silent on this particular point. So we need to compare the total loss and total depreciation. You have to compare loss before depreciation. Question is silent. So I have to tell to the examiner by writing a suitable note. I have to tell to the examiner by writing a suitable note that we have assumed that losses are before depreciation. Okay, so this is what is the analysis of the question for MAT purposes. Now, based on this whole analysis, let's do a calculation with respect to MAT. Net profit 215, provision for losses of subsidiary to be added, depreciation first to be added, then 375, then share of profit from partnership firm exempt under section 10 to be reduced. Depreciation is to be reduced again because there was no revaluation issue involved here. So total depreciation added, total depreciation reduced. Business loss, which is less than unabsorbed depreciation. As I have mentioned, we are assuming that these losses are before depreciation. So whichever is lower, 50 of business loss has been reduced. My book profit for MAT purposes is now 205. So I have got my normal taxable income. I have got my book profit for MAT purposes. Now it is simple comparison which is involved. Taxable income as per normal provision 105. The tax liability 25%. Okay, because the question is giving me a hint. My turnover for FY 18-19 is not more than 400 crores. Tax liability 25%. A book profit format 205. Tax liability 15%, 30.75. The final tax payable by the company would be whichever is higher. The MAT is the minimum tax payable by the company. Okay, there is some problem in PPT. Anybody is facing a problem, technical problem somewhere? Technical team, are you there? Solution slide not visible. Okay. Technical team, somebody is there? No. Students, just give me feedback. Now is it okay? Now visible. Okay. Fine. So computation of tax liability. The tax liability at the rate of 25%, the normal tax liability would be 26.25. Book profit for MAT 205. 15% is the rate of MAT. So 30.75 would be the tax payable under the MAT. So final tax payable would be whichever is higher. MAT is the minimum tax I need to pay. So my normal tax liability is 26.25, but then because of MAT, I will be required to pay 30 lakhs 75,000 as the tax payable by the company. Okay. So this is how this whole MAT calculation is required to be done. This is what is the same process of calculating MAT. Fine. Okay, still there are some technical problems. Everything is fine. No, some feedback is coming. Slides are not changing, they are saying. Yes. Slide number 3. Okay, so now this is what is the complete calculation. On this 30 lakh 75,000 tax, there would be a surcharge at the rate of 7%. Because my income is between 1 to 10 crore criteria, surcharge at 7%, cess at the rate of 4%, total tax payable would be 34 lakhs 21,860. Everybody is able to see the solution now? Just give me feedback, students. Okay, MAT calculation slide. This is what is this MAT calculation slide. Okay, this is what is this book profit calculation 205. After this book profit, this is what is this computation of tax liability. Okay, so I think now we can move forward. Various adjustments required for the purpose of MAT. What are the items which are to be added? What are the items which are required to be reduced? Okay, we have a detailed discussion about it. Why depreciation added back is only 100 instead of 150? Okay, yeah. Remya from Tiruvananthapuram, why depreciation added back is only 100 instead of 150? Okay, Remya, 150 is the depreciation as per Income Tax Act. For MAT calculation purposes, I'm not concerned with the depreciation as per Income Tax Act. What I need to look is the depreciation as per my books of accounts. So depreciation debited in P&L account is rupees is 100 lakhs. That has been added because there is no revaluation involved. So total depreciation added and total depreciation has been reduced. 150 is the depreciation as per Income Tax Act, which is to be considered for calculating normal income, but it has nothing to do with the MAT calculation. Okay, fine. So this is what is this MAT calculation. This we have covered. Okay, fine. I think very quickly what we can do is to take one more question. Is the time sufficient? Okay, let's take next 10 minutes. Let's use our next 10 minutes for this particular question also to give you a better idea, more practice about this whole MAT calculation. This is our second question. I will give you say not much of the time, but say next 10 minutes I can give you to just ponder over it, just think over it, just analyze it, and then actual solution we will do here. And if you are able to solve it even on a rough basis, send me your answers. And if you are reading it carefully, you are only required to calculate the MAT. And to know analysis with respect to normal income is required. It is only the MAT calculation which is required to be done. Both of these are past exam questions actually, which we are solving here. Okay, we have got our first answer already. This is Sumit Agrawal from Mathura. Your answer is correct. Raman from Delhi, you need to recheck it, please. Hmm. Remya from Tiruvananthapuram, you also need to recheck. Okay, Remya from Tiruvananthapuram, you are closer, but still not on the mark. Let's see it. Let's see it. Okay. This is what is the question again, and here I'm not required to do any calculation with respect to normal tax liability. The only calculation asked in the question is MAT under section 115JB. As I mentioned, it's an exam question, so they have asked only this MAT calculation, how this calculation is to be done. Okay, again the process should be first analyze each and every item given in the question, and then only start doing the calculation. So this is what we will be doing, analyzing every part, debit and credit and every item. Okay, so let's analyze this question. Okay, let's see it now. Now, all those who are sending the answers, let's see it here itself. Okay, now this is what is the question: items debited to statement of P&L. By now, I should have a very clear-cut idea about the basic process involved in the MAT. What I need to do, I need to scan the P&L account, various items to the debit, various items to the credit, and then I need to decide which item is to be added back to the book profit, which item is to be from the book profit for MAT calculation. Okay, so this is what we will do. The first item, provision for loss of subsidiary. Do I have any special provision for this? Yes, I do have. Section 115GB tells me that for MAT calculation, this item is required to be added back. Provision for doubtful debts. Do I have any special provision for this? Yes. 115JB nowhere mentions provision for doubtful debts, but it talks about any provision for diminution in the value of asset is required to be added back. So I am adding it back. Provision for income tax. Do I have any provision for this in 115JB? Yes. They specifically tells me that income tax is required to be added back. In the original question, it has been given that this income tax includes even interest on income tax. Doesn't make any difference, because in 115JB they have mentioned very, very clearly that income tax will include any interest paid under the income tax. All will be required to add back. So this is also to be added back. Then this is important. Provision for gratuity based on actuarial valuation. Okay, here where some argument would be required. What is the provision of law? Provision of law with respect to provision tells me that any provision for unascertained liability is to be reduced, any provision for losses of subsidiaries is to be added back, any provision for this uncertain liability is to be added back, provision for losses of subsidiaries to be added back, and provision for diminution in the value of asset is to be added back. Whether provision for gratuity, which is based on actuarial valuation, fits into any of these three categories. It is very clearly nothing to do with losses of subsidiary. Very clearly, it has not a provision for the diminution in the value of asset. The only possibility is it may get covered in that liability wala part. But with respect to liability, the actual requirement is this: unascertained liability provision is to be added back. Whether provision for gratuity based on actuarial valuation may be treated as an unascertained liability. I have got an actuarial valuation done that The actuarial valuation has given me a very fair kind of idea how much is going to be my gratuity liability. That much provision I have made. So it is not a provision for uncertain liability. Had it been an ad hoc provision, then I could have called it an uncertain liability. But after actuarial valuation, now this is a certain liability. If it is a certain liability provision, nothing is to be done. No treatment is to be given. Okay. Then depreciation debited in my books of accounts. Whatever depreciation debited is to be added back. And then net of revaluation depreciation is to be reduced. Then interest to financial institution. It's a very interesting point. I really admire the way examiners create question in examination. They have got absolute clarity where the students are going to get confused, and they will make all attempts to create a solid royal confusion in your mind. So this is that kind of idea. Interest to financial institutions. Sir, I know this is return unpaid before filing of return, so it is to be disallowed. It is to be added back. It is to be disallowed. It is to be added back for my normal income calculation, yeah, not for the MAT purposes. They have not said anything in 115JB for this. So for my normal income calculation, I would be adding it back. But for MAT purposes, I have to simply ignore it. No treatment. Similarly, penalty for infraction of law. Section 37, it says that any kind of penalty not allowed as deduction, it is to be added back. But that is 37 for normal income calculation. For MAT purposes, whether 115JB has said any such thing, whether it has mentioned that this type of amount is to be added back, no, that means no treatment is to be done. In the income tax, we do only what we have been told to do. A particular section telling us do this, we are doing only this. So 115JB has told us add back this, we are adding back only that much item. Anything about which section is silent, I'm not required to do anything. So this penalty for infraction of law, for my normal income calculation, probably I would be adding it back. Interest not paid up to the filing of return, for my normal income calculation, I would be adding it back, but not for MAT purposes. Why not for MAT purposes? Because nowhere it is written that it is to be added back. Whatever are to be added back, they have given me very, very clearly. So that much amount I am adding back. Anything about which MAT provisions are silent, I am ignoring all those items. So this is my debit to P&L account analysis. Then credit to P&L account. Profit from units established in special economic zone, SEZ. For my normal income purposes, I get an exemption for this. I get a deduction for this. Whether for MAT purposes also, I will get a deduction for this. Now, sir, in MAT, it is written any income exempt under section 10 is to be reduced. Now, sir, very simply, SEZ profits are not section 10. They are section 10A. They are section 10AA. There is a big difference between 10 and 10A, 10AA. So SEZ profits, though might be exempt, might be deductible for my normal income calculation, but for MAT purposes, only section 10 exempted income is to be reduced. 10A, 10AA, any other exempted income is not to be reduced for MAT purposes. So profit from SEZ unit for MAT purposes, no treatment. They will not be reduced. Share in income of an AOP as a member. Specific provision, direct mention, it is to be reduced. Agriculture income, indirect mention by way of section 10 exemption, it is to be reduced. Long-term capital gain on sale of building, no provision in section 115JB. Nothing is to be done for book profit calculation. Okay. So these are all my item by item analysis of say various items in my P&L account. Based on this whole analysis, now we can go for the solution, the treatment of different items for the purpose of calculation of my book profit. Okay, so net profit as per my P&L account 15 lakhs. Following items are to be added back. Provision for the losses of subsidiary, provision for doubtful debts, provision for income tax, including that interest, and whatever is the depreciation debited to P&L account, all have been added back. Then what is to be reduced? Share in AOP as a member, specific provision that is to be reduced. Agriculture income exempt under section 10, that will be reduced. Depreciation other than depreciation on revaluation of asset, 2,10,000 total depreciation added back, and then that depreciation other than revaluation of asset, that will be reduced. And then finally unabsorbed depreciation of brought forward business loss, whichever is lower. Now in the question, I have been given 10 lakhs as the loss, which includes depreciation. So before depreciation, my loss was 6. Unabsorbed depreciation is 4. Whichever is lower, 4 will be reduced here. 7,85,000 all in all will be the reduction. The book profit would be 13,25,000. Okay. So those of you who have got it correct, well done. Those of you who couldn't get it, just try to find out where you have committed a mistake. I'm sure there must be only one or two small mistakes here and there you might have done. So just try to find out where you have done a mistake. Okay, so based on this, how much would be my tax liability? 15% of book profit. Increase by cess. Surcharge would not be applicable because I am not crossing 1 crore. So 15% of book profit plus cess, 2,06,700 would be the final tax payable. Any issues on this? Any query if you want? We can spend. Good, Raman. Okay. So now we can move forward. This is what is the various issues related with the MAT. What all adjustments are to be done to the book profit, something to be added, something to be reduced. The story of MAT is actually the story of all these adjustments to be done to the book profit. Okay, whatever adjustments we have discussed, there are certain further adjustments given in the act, but on a practical basis, in a real life situation, whatever we have discussed till now, they have got some special importance. So as a student, for examination purposes also, you need to have an absolute clarity about whatever adjustments we have discussed till now. Remaining adjustments, we shall be talking about them also, but then you may probably dilute your importance for these adjustments may not be that much practically relevant, though academically obviously all provisions of the act are having their own importance, but from a pure practical perspective, whatever we have discussed till now, these are having higher degree of relevance. Okay, having said so, let's talk about other adjustments. Okay, further adjustments, some adjustments related with the business trust. The concept of business trust we will be discussing separately when we will be talking about the business trust. Okay, then only we will be able to appreciate what adjustments are to be done to the MAT. So this discussion we shall not be having right now. Adjustment related with the business trust. When we will discuss business trust, then we will talk about them. Then adjustments related with the foreign company. Even foreign companies are also liable for MAT. Even for on foreign companies also MAT provisions are applicable. It has been clarified that foreign companies are also required to prepare a P&L account with respect to their Indian operations, and profit as per that P&L account shall be the basis for MAT calculation. Now, for foreign companies, there are certain special adjustments which have been given. One is any capital gain arising on security transaction, that is to be reduced. Any income covered under section 115A, interest, royalty, fees for technical services, etc., which are taxed at the rate of 10% under section 115A, for MAT purposes, these income are required to be reduced. And then any expenditure related with these income, any expenditure related with these expenditure are required to be added back. Okay, so specific provision with respect to foreign company. Okay, there is a question from Sumit Agrawal Mathura. In case of foreign company not having any P in India, whether MAT is applicable in this case? Sumit, foreign companies are required to prepare a P&L account of their Indian operations. If they are not having any P in India, then very clearly there are no Indian operations, no P&L account is required to be prepared. So for them, this MAT would obviously be not applicable. Only when they are having operations in India, Indian operations, then they will be required to prepare their P&L account, and accordingly the MAT calculation would be there. So this is special provision with respect to foreign companies. Two incomes are required to be reduced: security capital gains on security transaction, and then income covered under section 115A. These two income would be reduced. Expenditure related with this income would be added back. Some special provisions related with the Ind AS companies. Okay, now in case of this Ind AS, there is a altogether different methodology of statement of P&L account. Okay, very different way of say P&L account. So with respect to this Ind AS company, now there are some special provisions. Okay, OCI adjustments, other comprehensive income section, which is there in this Ind AS statement of P&L. So with respect to that OCI part, now the adjustments are to be done in MAT. Okay, any amount debited to OCI under the head items that will not be classified to P&L account, the book profit is to be decreased by these items. For your accounting purposes, you have not debited them to main statement of P&L. You have debited them to OCI with the classification that they will not be reclassified to P&L. So Ind AS have permitted you to debit it separately. For MAT purposes, you have to reduce these items from your book profit. Similarly, any amount credited to OCI under the head items that will not be reclassified to P&L. So as per Ind AS, you are not crediting it to your main statement, you are crediting it to other comprehensive income part with the heading that items will not be reclassified to P&L. For MAT purposes, you have to increase your book profit for these much amounts. So these are these OCI adjustments applicable with respect to Ind AS companies. Okay. However, following amounts credited or debited to OCI shall not be adjusted to book profit in the year of debit credit. Now there are certain amounts which are there in this other comprehensive part. They will not be adjusted to the book profit in the year of credit debit. That is this revaluation surplus, and then gains or losses from investment in the equity instruments. These two items which are there in other comprehensive income part, but in the year in which they have been debited or credited there, in the same year they will not be adjusted to the book profit. their adjustment would be deferred. Now, this is a very important situation. All other adjustments we have said that in the current year's P&L, if you have debited, credited, so you have to adjust it for MAT purposes. These two items which are there in the other comprehensive income part, they are to be adjusted in the book profit, but not in the year in which they have been accounted for, but in a separate year. So what is the separate year? These amounts shall be adjusted in book profit in the year in which such assets or investments would be sold off. Today, there is a revaluation surplus. You have say adjusted in your other comprehensive income part. Current year, you will not be adjusting it against your MAT book profit. You will be adjusting these amounts against your book profits in the year in which these assets would be retired, disposed of, realized, or sold off. Okay, so this is what is this OCI adjustment with respect to Ind AS companies. Okay, so these are certain what we can call advanced level adjustments. In some special cases, these other adjustments may be applicable for the purpose of MAT calculation. The business trust concept we have not discussed right now. When in the next session we shall be talking about the basic concept of business trust, then we will discuss those MAT implications. Foreign company, two special types of income are to be reduced. Expenses related with that income are to be added back. And then with respect to Ind AS company, OCI adjustments, okay, items not to be reclassified to P&L account, debited or credited to other comprehensive income part. For MAT purposes, they are to be added back or they are to be reduced from the book profit. Okay. After developing this sort of clarity about various items to be adjusted from the book profit, now the remaining portion of the MAT discussion. Okay, some small incidental topics, issues related with this MAT. The main part of MAT is over here. As I have said earlier also, the story of MAT is actually the story of all these adjustments, what is to be added, what is to be reduced. So after completing all this discussion, now some other related topics related of the MAT. Okay, MAT not applicable. There are certain companies for this for which all this jugglery is irrelevant. They are absolutely out from the coverage of MAT. What are these companies? Okay, Sumit, this is your answer. Foreign companies resident of a country with which India is having a DTAA, and that assessee does not have any permanent establishment in India, no PE in India, no Indian operations. For these kind of foreign companies, MAT is not applicable. Second case, company is a resident of a country with which India does not have a DTAA. Okay, and assessee is not required to take any registration in India, then for these companies also MAT is not applicable. Okay, foreign companies, they are resident of a country with which India do have a double taxation avoidance agreement, but assessee does not have any PE in India. Second case, company is a resident of a country with which India does not have DTAA. And then a company is also not required to take any registration in India, then again the MAT is not applicable for these foreign companies. And then these are the companies which are exclusively covered under those presumptive taxation 44B, 44BB, 44BBA, or 44BBB, shipping companies or airline companies kind of thing, which are presumptive taxation provisions applicable for foreign companies. These companies are having only that much income, offered the tax as per the rate specified in those sections, then again for these foreign companies, MAT would not be applicable. So three types of foreign companies, MAT is not applicable. And then One more type of company for which MAT is not applicable, that is insurance companies. Okay, section 115B. Rather, it is not applicable for whole of the company. Exact requirement of the act is this, that any income arising to a company from the insurance business, no MAT would be applicable on that much business. And then this is what we already discussed in the last session. Any company who will be exercising this option under section 115BAA or BAB, for them also MAT is not applicable. 115BAA and BAB both are new provisions from the current assessment year, that is AY 2021 is the first year of their applicability. So right now various companies in the country are actually in the process of doing this comparison whether to go for this option of 115BAA or not. One of a very important factor of decision is this MAT. If MAT is applicable on you, then probably you may wish to go for 115BAA in order to save that MAT liability. Okay, so 115BAA or 115BAB option has been exercised, then the MAT is not payable. Tax would be payable only as per the normal provisions, 22% or 15%. Okay, so these are the companies which are out from the purview of MAT. For them, MAT is not applicable. Okay, last part of our discussion, concept of credit of MAT. Any queries, any questions till now? We can have certain questions here. Anything you would like me to discuss again to emphasize it further? A branch of a foreign company in India is treated as a foreign company. Yes, Raman. A branch is equivalent to its parent body. So any branch of a foreign company is treated as a foreign company. That is what is the idea. If a foreign company is having any Indian operation, any branch, then they need to prepare a statement, a profit and loss account for that much branch from those Indian operations. And based on this, the MAT would be applicable. Okay, fine. So now the last part of this whole MAT jugglery, MAT, very, very important of overall corporate assessment part. Now a very important concept related with this, the last part is this credit of MAT. But before we go for this credit of MAT, again, the basic idea I would like to emphasize, in examination, they may not give you any hint about MAT at all. Like we did that question, they will simply tell you that calculate the tax liability of the company. Okay. Normally, whenever I have been asked to calculate tax liability of any assessee, the idea in my mind is calculate the taxable income, apply the tax rate, and find out tax liability. In the case of company, now invariably we have to keep in mind that the basic conceptual clarity should be there, that in case of a company, invariably whenever the tax calculation is to be done, it has to be done as per two processes, the normal process and the MAT process. Unless question is saying ignore the MAT calculation, I cannot ignore it. The tax liability is to be calculated. It has to be as per normal process. It has to be as per MAT process. This is what is something very unique feature of a company assessee. The MAT is always applicable. Whenever there is a company tax calculation, the MAT calculation is always involved. I needed to do this calculation. I need to find out whether my MAT liability is more than normal tax liability. If yes, then the tax has to be paid as per MAT. Now Income Tax Act further says that if my MAT liability was more than my normal tax liability, so I have paid tax as per MAT provision. That means I have paid some tax excess over and above my normal tax. I have paid some excess tax because of MAT. Now, whatever is this excess tax I have paid, I can claim a credit of this excess tax. Okay, before this, there is this query from Remya. Remya, please clarify what do you mean by FSC? Okay, we will take it after the class then. Fine. So credit of MAT. So what I was saying that whatever is the excess tax company has paid because of MAT provision, this excess tax can be claimed as a credit by the company. This is what is the basic idea related with the credit of MAT. Okay. Section 115JAA, amount of excess tax paid by the company under the MAT provisions can be claimed as a credit. Okay, so we need to see two things here. First is how much credit can be claimed by the company, and second is how that credit can be utilized, how that credit can be adjusted, what adjustment is possible against that MAT credit. Okay. So how much is the credit available? The concept is this, the idea is this amount of excess tax paid by the company. Okay. So amount of tax which is allowed as credit shall be the excess of MAT tax over my normal tax. No MAT would be there. How much tax would have been payable by the company? Now MAT is there, then how much tax is payable by the company? That difference, that excess creates credit. How credit gets created and then how it gets utilized. Two aspects of the story. So how credit gets created? How much is the credit? Excess tax paid because of this MAT provisions, that much is the credit available. So let's generate an infographic for this MAT paid minus normal tax. That is my MAT credit. MAT paid minus normal tax, that is my MAT credit. So in any year when I am paying a tax because of MAT, then there will be a MAT credit generation. Okay. Now mechanism of MAT credit. How that credit can be then utilized. It has got generated this year. My normal tax liability was 100. My MAT liability was 140. So I have paid 140, but this 40 has been generated as a credit to me. Now what I will do, I will carry forward this credit and I will adjust that credit in subsequent years. In subsequent year, set off of brought forward tax credit would be allowed. But in subsequent years, and here where is the catch? I can adjust this credit only in the subsequent year when my normal tax is more than tax under MAT. Whenever in subsequent years, the situation would get reversed. In the original year, MAT was more, normal was lower, the credit has been generated. Whenever the situation will get reversed, normal will go up, MAT will be low. In that year, I will be allowed to adjust this credit. And then this credit in subsequent year, when the situation has got reversed, in that subsequent year also, the credit shall be restricted to the excess of normal tax over the MAT liability. I cannot use the full credit. I can use the credit only to the extent of excess of normal tax over the MAT liability. So MAT is more, normal is lower, the credit has been generated. Next year, normal is more, MAT is lower, the credit has been utilized, but it has been utilized only to the extent of excess of normal tax over MAT liability. This is what is the mechanism of MAT credit. Now, till when I can carry forward this MAT credit? Because I'm not very sure when my normal tax liability would be more than MAT, when I will be able to consume my MAT credit fully, so I can keep on carrying it forward year by year by year basis. Law says maximum MAT credit you can carry forward is for 15 years. If within 15 years you are able to utilize it, it's fine. Otherwise, this MAT credit will get lapsed. Okay. So what we can do just to see this whole mechanism of MAT credit through certain numbers. But before this, Sumit's query from Mathura, it is mandatory first MAT credit set up against the MAT credit when he opted for section 115BAA. Okay, very important clarification related with MAT credit. In the case of companies who are opting for this 115BAA, BAB, that whatever is the MAT credit available to them till date, all this MAT credit would get lost. If they opt for this 115BAA, BAB, the MAT credit would get lost because they will be out from the MAT provisions. The MAT would not be applicable. So whatever is this past MAT credit, that will also be of no use. The MAT credit would be lost fully. So in order to decide whether to go for 115 being a good MAT credit being carried forward, then you may take that also into consideration. But the point is this, that MAT credit you will be able to utilize only when your normal tax liability would be more than your MAT liability in any of the subsequent years. Okay. So the answer to your query, Sumit from Mathura, that if you opt for 115BAA, the carried forward MAT credit would not at all be available. It would be lost forever. Okay. So now let's see this whole MAT credit idea with respect to certain numbers, how this whole mechanism works. Okay. So this is my first year where my normal tax liability was 50,000. As per my normal tax calculation, 15% of my book profit, that is my MAT liability, was 80,000. So very logically, I have paid a tax of 80,000, whichever is higher, I have paid. And because I have paid a tax under MAT, MAT was high, a credit has been generated. 30,000 is the MAT credit generated for me in the year one, which I am carrying forward. From here, the story starts. The MAT credit generated and now it is being carried forward. Now let's see what happens in year two. Now year two, my normal tax is 70, MAT is 90. Again, my MAT is high. So my tax payable would be 90. Though I am having a credit of 30,000 being carried forward, but in this year, I cannot use that particular credit. No use of that credit for me in this year. 90,000 would be the tax payable by me. MAT is the minimum tax. So minimum 90,000 I have to pay. This year again, because my MAT was high, normal was low, so 20,000 additional credit has got generated. 50,000 is the total credit which is available to me. Okay. Yeah. Third year, Now the situation has got changed. It has got reversed. 1,50,000 was my normal tax. MAT was 1,10,000. So now my normal tax liability is higher. I would be required to pay 1.5. Here I can use my MAT credit. 1,50,000 is tax payable by me. 50,000 is the credit available to me. Whether I can use total 50,000 credit here? No. 1,50,000 minus 50,000, this would be 1 lakh, which will go below MAT. MAT is minimum tax. Again and again, we need to keep this thing in mind. Minimum I have to pay MAT. I can pay more, but I cannot pay less. So maximum credit which I can utilize here would be 40,000 only. 1,10,000 tax I would be still paying, which is equal to the MAT, which is my minimum tax liability. 10,000 credit I will carry forward. Okay. Fourth year, 2 lakhs is the normal tax, 150 is the MAT. Here again, I can utilize the credit. Okay, normal tax is what I am paying, higher of 2. So 2 lakhs is the tax which I will be paying. Here again, I can utilize the credit. I can utilize the credit up to this difference between normal and MAT up to 50,000. I can utilize the credit, but the credit which is available to me is only 10,000. So 2 lakhs minus 10,000, 1,90,000 would be the tax payable by me in this case. Okay. Third year is very important for us to see. I'm paying tax of 1,10,000, though I'm having credit of 10,000 still available with me. But I cannot use this total credit here. I cannot say I will pay only 1 lakh. I have to pay 1,10,000. 10,000 credit I will carry forward. Okay. Why in third year I'm using only 40,000? Because MAT is the minimum amount I need to pay. In fourth year, MAT is 150. I'm paying 190. So I'm paying more than the minimum, which is okay. But I cannot pay less than minimum. Minimum is what is required to be paid. So in third year, 1,10,000 would be the tax payable. 10,000 would be the credit being carried forward. Okay. This is what is this complete mechanism of MAT credit and utilization. Now, one very, very important issue related with this whole MAT credit remains. How much would be the MAT credit generated in the year in which MAT is more, normal is lower, then the MAT credit would be generated. Now, how much? Very simply, we have said difference between MAT and normal, but a very, very important question remains. MAT and normal, their difference is to be taken, whether this difference is to be taken before cess and surcharge or after cess and surcharge. In the question, deliberately, this concept has been kept hidden. This 80,000 and 50,000. Now, whether this 80,000 is before cess surcharge or it is after cess and surcharge, at which level this comparison is to be done. Whether the comparison is to be done at the level of tax or it is to be done at the level of tax plus surcharge plus cess. Okay. Law is not very clear. Section is not very clearly saying that at which level comparison is to be done. But the generally accepted view, that the interpretation which is being generated based on the language of the section, that comparison is to be done after cess and surcharge. At the final figure level, this comparison is required to be done. But in question, in examination, if any of this question comes, my suggestion would be you write a clarificatory note also. You can take figure after surcharge and cess in order to find out how much credit is available, but then just make a note, just give a clarification that there is a view according to which the credit only at the level of tax can be carried forward. However, we followed another view and took the credit after surcharge and cess. Write this clarification, let the examiner know that you are aware about other side of the story also, because there is not absolute clarity is not available. The law is not very clear, but generally the practice which is followed, that is this credit is calculated after surcharge and cess. Okay. Fine. So this is what is we are having for the purpose of our discussion with respect to MET. The assessment of companies, assessment of entities is our main topic. Out of this company assessment, the most important topic for the final level, we have spent two full sessions in analyzing various, say, nuances of this particular topic. So this is where we complete our discussion related with the assessment of companies. Further two sessions have been allotted to me where I will be discussing about assessment of other entities, okay? Partnership firms and individual and LLPs and business trust and securitization trust and all those other entities and AOPs and mutual concerns and all other entities. What are the special provisions applicable for them? That we will be discussing in next two sessions. Okay, before I conclude this particular session, of course there are certain questions to be answered which I will be answering, but then before I conclude this session, I wish all of you a very happy new year. We all are eagerly looking for a prosperous, a very different kind of 2021. And for all of you, I feel this 2021 should have some additional significance because you all will be appearing for your final examination. So you all must be looking to this new year with much more eagerness, with much more enthusiasm. All the very best. Very happy new year to all of you. Okay. We will answer all those queries which have been raised in the meanwhile. Yeah, in the case of amalgamation, will MAT credit get carried forward to the amalgamated company? Question from Remia. No, no such mechanism in the Act whereby you can carry forward your MAT credit in the case of amalgamation. In case of amalgamation, you can transfer to the new company only your losses and carry forward depreciation, nothing else. So MAT credit is not carried forward. Okay. Sumit from Jaipur, can MAT credit of surcharge and cess be interutilized? Say if you are calculating credit after surcharge and cess, the total credit you can utilize against your next year's liability. So there is no surcharge to surcharge, there is no cess to cess kind of calculation. This is not GST, boss. IGST to IGST and CGST to CGST. This is not the concept here. Total MAT credit can be utilized against the say against the liabilities next year. Yeah, amount equal to MAT is always payable. You even after adjusting the credit, the minimum amount up to the MAT is payable. You can pay more than the MAT, but you cannot pay less than MAT. Okay. Okay. So these are all the questions. Fine. I think we can conclude this discussion here and then can do some celebrations for the new year. Okay. So again, wishing all of you a very happy new year. Thank you very much. Yeah, Jay. Happy